Okay, hi everyone. Welcome to our webinar on asset protection. If you guys, somebody can just let me know if you hear me and just type a chat, say that you hear me, and then we'll get started. Okay, great. Thank you, Judah. Thank you, Moshe. Very good. Okay, I'm sharing my screen with you, so I assume that you see my screen. And let's dive right in. So today we're going to be talking about asset protection strategies, how do rich protect their money. We're going to try to make this quick, and I'll explain you why, because we're not going to dive into any of the details too deeply. It's probably stuff that you already know, and we can't get into it as deep as you have to. Each one is a webinar by itself. So we just want to show the overall picture, touch all the bases, maybe spark something that you haven't heard before, and pique your curiosity to go further with it and to think about how to protect your assets. So today's agenda will be what are the risks? And we'll be talking specifically about real estate. What are the risks, protection strategies, and the protection tools? So disclaimer, this is just for entertainment purposes. I hope it's entertaining. I don't know if it will be, but whatever knowledge you have, please check with a professional before you rely on us, or don't rely on us, check with a professional. So when it comes to building wealth, we know it takes a long time. Some people build their wealth instantly, but most people build it over time. When it comes to losing it, lots of people lose it very, very quickly. And you want to make sure that you have safeguards around it in order not to lose it all just with one mess up, especially when it comes to real estate. Now, there's living proof that you can be very, very wealthy even after you really messed up. You have a guy like O.J. Simpson who had lots of lawsuits against him, but his assets were protected. So as much as was taken away from him, that much more was saved, and he lived a good life till the end. Donald Trump, or President-elect Donald Trump, has gone bankrupt multiple times, but he's still smiling. And even the great Robert Kiyosaki, the father of many people's real estate wealth, he also had a lawsuit and lost lots of money, but it was protected, and he went on and is doing just fine. So the idea is for you to join this list of building wealth and keeping your wealth. When it comes to real estate, there's risks no matter which real estate you're in, whether it's industrial, residential, commercial, or even raw land. Everything is full of risks and everything has to be protected properly. So let's talk about some of the liability exposure. You have a plaintiff. When the plaintiff attacks, the first thing they're going to go for is the property. If something happens on your property related to your property, they're going to go for your property. If that's not enough, and often won't be, they'll try to get at your personal assets. So we need to protect both your property from the plaintiffs, and we also need to protect your personal assets from any claims against you because of your property. Now, not only that, you see there's a double-sided arrow between stage 1 and stage 2, because anybody coming after you personally, whether you have an accident or something, somebody's claiming something against you personally, you want to also protect your business holdings, that they should not be fair game for the plaintiff. So what are some of the liability exposures? And there are many. There's a premises liability, there's negligent security, fair housing violations, unsafe living conditions, environmental hazards, data breach. Today, there's even data breach in cybersecurity, which can cause a big lawsuit, construction defects, personal injury due to some of the equipment or amenities that you may have, fire safety and building code violations, workplace injuries for any of the employees that are on the premises, infectious diseases, let's not forget that one, and trespassing and attractive nuisance, which means that even somebody comes illegally on your property, you can still be liable and they can sue you for everything you got. Now, another type of exposure is your financial exposure. So you have a property and everything looks great, all the numbers add up, but there's market risks, there's downturns, there's interest rates, there's oversupply. And if you owe people money, it's not just about lawsuits, it's about business lawsuits as well. They can come after either your property or they can come after you personally. Legal and regulatory risks, whether it's zoning and tenant lawsuits, financial risks, whether it's tax and liquidity. Even if business is good, you have a liquidity problem that can bring your whole structure down, and it can affect more than one entity if you're not protected properly. Operational risks, and of course, environmental risks, which we've seen way too many of, natural disasters, contamination. So we see that there's no way you can protect yourself or predict all the risks that you'll be facing. It can happen from any side, anytime. And that's why you need to protect yourself as well as you can. So what are some of the protection strategies we're going to use? First one is to protect from a lawsuit. So somebody wants to sue you. How do we make sure that nothing happens to you? They don't take anything from you, whether it's your building, whether it's your business, whether it's your personal assets. So we're going to figure out how we're going to have some strategies to protect from any lawsuit, that you come off clean without paying anything. Then there's to hide your assets. And to hide your assets is really a very, very big theme when it comes to asset protection, because a lot of these lawyers work on contingency fee. So what they're looking for is lots of money. And if they see money, they'll go after you. But if they don't find money, then they won't go after you. Now, and we'll talk more about this along the way. But the key is that the lawyer, you have to tell the judge all the assets you have, but that's only after you lose the case. When somebody sues you, it's not their business what your assets are. Only when they win is it their business. So to go through a couple of years worth of a lawsuit, a long lawsuit, just to get to the prize at the end, and you don't know what the prize is, then it may not be worth it for the lawyer, and they may settle for a lot less. Separate your assets. As long as they're all in one basket, if somebody makes his way into that basket, they can take everything. But if they're in separate baskets, they'll have to work their way through each basket one at a time in order to get it, which will make it much more tedious and much harder to get at. And oftentimes, because they're separate baskets, they won't even be able to get at them. And the last one is to devalue your assets. So if your assets don't have a lot of money in them, then there's nothing to take. And we'll talk about some strategies for that at the end. Okay, what are our tools? So those are our strategies. Those are the principles of asset protection. Now we're going to drill down to some of the tools that we use in order to accomplish all these strategies. The first one is protected assets. There's certain assets that by nature, by law, nobody could take from you. And the idea is, as much as it makes sense, to shift your wealth and shift your money into these protected assets. The next one is insurance. Now you're going to have to pay for insurance, but when you need it, it will help a lot. And I just want to we'll talk about insurance in a minute. LLCs. LLCs, what they are is they're entities separate from you. Therefore, nobody could come after you. They could only come after the LLCs. And there's a separation between you and the business. Trusts. Trusts are a very interesting animal, and we'll talk more about those later. And last but not least, liens on your property. Okay, so let's dive in one at a time. Anybody have any questions until now? Okay, so we will continue. Protected assets. So there are assets that are protected by the federal government, by federal statutes, and there are assets that are protected by state statutes. So a 401k plan and other qualified retirement accounts are protected. Creditors cannot get that. So if you put money in your 401, that's money that will never be touched. Traditional and Roth IRAs, Social Security benefits, disability and unemployment benefits, and wage garnishment limits. So if you have a W-2, they may be able to take some of it if it's a high salary, but there are limits to how much they can take, and they'll always have to leave you some. On the state side, we have a homestead exemption, and that everything depends on what state you're in, but homestead exemption means that creditor cannot get after your home. In Florida, that's 100%. Any home that you own in Florida, if you live in Florida, is exempt, and nobody could ever take your home away from you. I think that was one of O.J. Simpson's benefits, that he had a home in Florida. But in other states, there's limits to how much the value of the home is. So if the homestead exemption is $100,000 and you have a $3 million home, it's not going to do you too much good. Cash value of your life insurance policy and annuities. So if you put money in that, you're also protected. Personal property exemptions. There's certain things that are basic things that the government lets you keep, and they can't take literally the shirt off your back. And tenancy by the entirety for married couples. Because there's two people involved, it becomes harder for a creditor to take the assets away. And then education savings account for whatever that's worth, but that's also protected. Let's talk about insurance protection. Now, the thing with insurance is that, again, these lawyers work on contingency basis. So a lot of these lawsuits involve egregious amounts of money, and the lawyer knows that they're probably not going to get most of it. If the insurance is enough for the lawyer, now again, this is not unfortunately very ethical, but that's just the way it is. If the lawyer says, look, they have $1 million insurance policy, he says to himself, okay, I could sign tomorrow morning and get $300,000 and get my tenant the rest, get my client the rest. I'm going to do it rather than go for the $20 million because that's just a pipe dream. So as long as there's enough money to make the lawyer happy and he could convince his client of it, which is pretty easy to convince the client because they can sell the chance of winning the lawsuit any way they want. And, even if the person gets a second opinion from another lawyer, they're the same lawyer and they have the same interests in mind. So insurance is important that you have adequate insurance, because if there's not going to be enough insurance, then the lawyer will not settle for the insurance and then you'll be in trouble. So the best thing is to keep the lawyers at bay with insurance and make them happy. So you have property insurance, you have general liability, loss of income and business interruption, umbrella for excess liability, workers' comp, directors and officers, errors and omissions, cyber liability, flood and earthquake insurance, environmental pollution liability insurance, and ordinance of law insurance. And those are the insurances. So you see, it's not just, you have to think about all the angles, and for every possible risk, there will be somebody happy to sell you another insurance policy. So it's all out there. It's just a question of understanding your risks, which insurances make sense. So let's dive into what the considerations are before buying an insurance policy. So you have deductibles and policy limits. The higher deductible you have, you can reduce your premiums. And that's just a question of risk versus how much you have to pay out and how much you're willing to risk. You have coverage gaps. So again, you need to figure out, really, you don't want to just buy every insurance across the board. You want to figure out which insurances, which risks you're exposed to, and which are the risks that if they happen will do you in, and which you can overcome even without the insurance. And then there's risk mitigation. There's certain things that insurance can do that the insurer will give you discounts on your policy because you're implementing safety measures, which lowers the risk, and therefore the premium will go down. But at the end of the day, all these things are nice, but you have a business to run, and insurance is just one component of it. And if you're going to spend all your money on insurance, you may actually not be making a profit. So you really need to figure out how much you're willing to spend, how much flexibility there is in the business in order to spend on insurance and still run a profitable business. Now, there's something called captive insurance. Captive insurance, there's before we get to captive, there's portfolio insurance. You don't have to insure each building at a time. You can get a insurance across your entire portfolio of real estate, which will obviously lower the costs. The downside of the portfolio insurance is that each property may have different risk exposures. So one size does not fit all. So therefore, you may want to break it up rather than get a portfolio. But if you can get a portfolio insurance, it will certainly save you money. Then there's the concept of captive insurance, which some of you may be familiar with. Captive insurance is that if you have enough property and you're paying lots of money in premiums, it may make sense to self-insure. Since the risk is spread out among so many different properties, then each one will balance the other, which is essentially the way an insurance company works. So you become an insurance company for yourself. Some of the benefits of captive insurance are cost efficiency. You'll save yourself a lot of money. Risk management. You know exactly the risk you need, and you can figure out how much money you have to set aside for the insurance that you're insuring yourself. And claims control. When something happens, the insurance companies are always there when it's time to pay premiums and to sell you a policy. But when it comes to collecting your money, things are much more complicated, and there's all kinds of paperwork, and there's all sorts of fighting before you actually see the money. So when you're your own insurance company, you have no problem with claims control. When you have a claim, you can get it pretty quickly. Now, what are the challenges of captive insurance? First of all, the initial setup cost. It costs a lot of money to set it up. It's not like you could just say, okay, I'll put money in the bank. It has to be set up like an insurance company. You actually become an insurance company. An insurance company needs lots of licenses, and it needs to be run like an insurance company. So there's a lot of management complexity, and there's regulatory scrutiny. The government doesn't say, since you're only insuring yourself, you can do whatever you want. They will hold you to all the rules of insurance companies, and you really become an insurance company and play by all the rules. So it's not as simple as you think. It's literally setting up your own insurance company. So that being said, which type of property, which type of real estate investor or property owner does it really make sense to have a captive insurance policy? So if you're a developer or a REIT with annual insurance premiums of $1 million or more, and you have a predictable risk profile, you understand, you need to, before you take on such an endeavor, you really need to understand your risks to make sure that you're doing it the right way. And you need to have a loss experience. You need to see not only what you think, but what typically has happened during the course of a year in your business. And you should have at least $50 million or more in assets. Now, for those who aren't big enough to have their own captive insurance, there are other solutions. A smaller company can have a group captive insurance. A number of companies can get together and create their own insurance company and create their own captive insurance. So if you have closely affiliated groups that you work with in the business and you all trust each other, you can get together and create a captive insurance group. And another thing you could do, some of these insurance people that do captive insurance, they put in all this money for infrastructure. They would be willing to rent you insurance on their insurance, on their captive insurance, which essentially means rather than going to a regular insurance company, you're going to a really small insurance company that set themselves up for themselves. But they, even if they're not funding it for you and they're not giving you, you're doing it yourself, but they're renting you the infrastructure that they created to run your own captive insurance company, which makes it easier to set up. Let's talk about limited liability companies, and this is one of the key pillars of asset protection, because limited liability is exactly that. There's two parts of limited liability. First of all, the entity is seen as separate from you. So if you have a limited liability company, it stands by itself, and there's absolutely, or theoretically, and we'll see, no connection between you and that company. So nobody can come, anybody who's suing the limited liability company, the LLC, cannot come after you, because even if you're the sole owner, it doesn't make a difference. It's not you. And the second part of it, let's go further. Okay, so LLC also has privacy. There are certain states, every state has their own LLC laws, and some states offer you privacy for your LLC where they won't put your information in the public database. Now, the places where they don't have privacy, you would have to have member details. Some members would be listed, and that's, again, public information. Manager details, who your registered agent is, which is why a lot of people use somebody else to be their registered agent. They don't use their own address as a registered agent. And the principal place of business, which is never a good thing because they know exactly where to find you. But if you are in a state where there is privacy, then nobody can find you. Now, the question is, you need to have an LLC where your property is if you're an active investor. So if you're an active investor, how do you keep your privacy? So the answer is simple. You can have a holding company, because the rule is that an LLC, the member of an LLC could be another LLC. So even though you need to list the member details, the member could be an LLC. The manager could be an LLC. And you can get a principal place of business that's not related to you. And therefore, anybody looking to see who owns this LLC, because it's in the public database, will find that it's owned by another LLC. Now, that LLC, you can put in any state you want. So what you're going to do is put that LLC in a state where there's total privacy. And we'll talk about that more in a minute. Now, even if you have a perfect setup for LLCs and everything's private, you have to be careful, because there's online media. If you're associated with a company and people slip up, whether it's on social media, whether it's on the internet, then you will lose your exposure, and people looking for you know how to search online to find who the owner is. So if you're not careful and you leave too many traces or any trace, you'll be found. And the same with business operations. If your name is on business operations and different places, then they'll find you. Okay, so now the other part of LLC is the asset protection. As we said, if somebody sues the LLC, they can only go after the LLC and they can't go after your assets. So the first thing we have is inside protection, which means if somebody sues the LLC, they can't come after you. And there is one way for them to come after you it's called piercing the corporate veil, which means they go to the court and they say, look, this is an LLC, but the owner of this LLC is totally responsible. They were negligent. They violated the rules of the LLC. So it's not really an LLC. The LLC is just the veil for the person themselves. And there are certain things you could do, negligence among them, or anything that violates the operating agreement, that the court will actually allow them access to your personal assets and able to sue you personally, even if they're suing just the LLC. And then there's outside protection. If somebody wants to sue you personally and you own an LLC, they would love to get after that multi-million-dollar property that you have that's sitting in an LLC. And what that's called is charging order protection. Most states, or many states, will not allow them to get after the property in the LLC. What they'll be able to give them is the distribution, because I get the distributions. If it's my LLC, I get the distributions. But as soon as it's distributed, it becomes my money, and therefore the creditor can take that money away from me. But they can't get anything from inside the LLC. They can't force me to sell the asset. They can't get any percentage of the asset. That's not going to work. So the question is, what difference does it make? The answer is very simple, because if you don't take a distribution, there are other ways you can move the money around inside the LLC or through other LLCs to keep it out of the creditor's hands. And then you have the problem of the single member LLCs. Unfortunately, many states don't allow protection. They don't allow charging order protection for the LLCs. What they say is, the reason why we protect the LLC if there's a personal lawsuit against you is that they're members of the LLC. It's not just you. So we can't let them have the assets because they belong to everybody. But if you're the sole owner of the LLC, then there are many states that will say it's you. It's essentially you. And there's no difference between you and the LLC. And therefore, they can force you to sell the assets to pay the creditor. So the states with charging order protection for single member LLCs that have full charging order protection. Now, a lot of states are in the middle. Some have announced that they do not have charging order protection, and these states have said that they do. And even a single member is protected by statute, that nobody can go after the assets of the LLC. Those are Delaware, Nevada, Wyoming, South Dakota, and Alaska. Then there are a number of them that have said that there is no protection. One of them is Florida, generally a good state for business, but in this case, not. And then there are a whole bunch of states that are quiet on the matter. They haven't said anything. So if you have a single member LLCs, you risk the chance that if it's taken to court, the court can decide if there's charging order protection or not. So it's better to be careful. And there are ways, which we're not going to get into this in this webinar, in other webinars we discussed this, in order to protect yourself when you have a single member LLC. So this all boils down to Wyoming. Wyoming is generally, if you are a single member LLC and you have real estate, you probably want to be in Wyoming. Wyoming offers total privacy. Wyoming has asset protection, the best asset protection. They don't pierce the corporate veil. They have full charging order protection, and they protect single member LLCs. They also don't have state taxes. And the fees for Wyoming LLCs are very cheap. Now, that generally is if you're working on your own. But if you are setting up a real estate company and you will be inviting investors to invest with you, Wyoming is probably not the best place to go, because lenders don't like it, investors don't like it. If you go to Delaware, which is why we see so many Delaware LLCs, that's a place that has decent privacy, decent asset protection, and it's sort of the blue chip. When you're a Delaware LLC, the banks are happy to lend to you and the investors will come to you. In fact, there are many people that have LLCs outside of Delaware, and when they go to get a loan, then the lender will often force them to get a Delaware LLC if they want to have the loan. So let's see a typical case. You have your first purchase and you're getting your feet wet in real estate. You buy a property. Now the question is, how do you set it up? Let's go back here a second. Okay, so typically what we find is property in their own name. And they don't, sometimes they know that there's an LLC, but it's a little bit more complicated to buy a property from an LLC. Sometimes it could cost more. But the worst thing is to do is have it in your own name. So if you have it in your own name, you want to put it right into a LLC as soon as possible. The problem with putting in an LLC, once you have it in your own name, is that there's a due on sale. Most mortgages have a due on sale. If you sell the property or transfer it elsewhere, the bank can ask you to pay the full mortgage on the spot. They don't have to continue a mortgage once it's sold. Generally, you can speak to the bank, and especially if you are going to give a personal guarantee, once you put into the LLC, the bank will usually let you do it. Another problem is that the title insurance expires, and the title insurance only works for you, not for the LLC, but generally you could call up your title insurer and ask them just to switch the name on the policy to the LLC, but make sure you do that, because if you don't have title insurance anymore. Sometimes some states have a transfer tax. So if it's in your name and then you put it into the LLC, you're going to pay that transfer tax. So now you have it in the LLC, but your LLC is not in a great state, let's say. It's in a state where there's no anonymity and the protection, the asset protection is not that good. So what do? When you form that LLC, what you want to do is you want to have a Wyoming holding company. So Wyoming is going to be the owner, your Wyoming LLC is going to be the owner of that local LLC, which means that you now have total anonymity, because the only member listed in the state that's not anonymous is the Wyoming Holding LLC. You also have protection, because if somebody sues your LLC in a state where they can actually get after your personal property, then that state will let them go further. But the next step is the Wyoming Holding Company. The Wyoming Holding Company doesn't have anything in it. So therefore, they will get stuck and they won't be able to get to your personal assets. Same thing if somebody sues you personally, they'll have to fight their way through the Wyoming Holding Company in order to get to your local property LLC, which won't happen. So by having a holding company, you will be protected even though the initial LLC is in a state that's not favorable to LLCs. So what happens if you have passive LP investments? We said that you need a LLC in the state where you are operating, where you own a property. But that only goes if you're an active owner of the property. What happens if you're a passive owner? Passive owner is not considered doing business in the state. Therefore, it doesn't need to have an LLC in the state. It's just an investment. And therefore, you can set up a Wyoming holding company, which can invest directly into your limited partnership. You can do it by yourself too, but again, then you run the risk. Somebody sues you personally, they could get at your LP holdings. Not only that, if somehow they break through the LP, a limited partner typically cannot be sued personally, but if they are, then you'll be on the hook. So it's better not to have yourself as the owner in the LPs. People generally think that if you are an LP, it's okay to go in through your own name, but it's not advisable. It's easier to set up one Wyoming holding company, and as opposed to active LLCs, where you're an active owner, where we'll talk about in a second, you should have one LLC for every property. When you're a passive investor, it's okay to have all of them in one holding company, since by the nature of their limited partnership, they anyway are not connected between each other. So it doesn't all fall into one basket. And if they sue one LP, they can't get their hands on the other LP anyway. So now you have a growing portfolio. You have 3 LLCs holding 3 separate properties. And the reason why we don't put them into one LLC is because if somebody sues the LLC on one property for whatever reason, they can get all the assets in that LLC, which would include the other 2 properties. So we separate the LLCs. Each one stands by itself. It's held by your Wyoming holding company. And now we ask ourselves, where is the biggest risk? The biggest risk is to property management. So most people, once they have a number of companies, will set up a property management company, because the property management company is really the first line of defense. When somebody sues, they'll sue the property manager. They don't know the owner of the LLC. They won't sue them, but they'll go after the property manager because they have face-to-face contact with them. And at the end of the day, they're responsible for managing the property. The beauty of the property manager is the LLC has no money in it. So if you can, instead of having them sue your LLC, your property directly, if you can throw the property manager in the way, then you're a little bit better off. At the end of the day, they probably will come after the LLC because lawyers are smart and they go after where the money is. But having a property manager LLC will certainly lower the risk exposure. Okay, let's touch on trust. Trust is a world unto itself, but let's just get some basics down and talk about some basic things you can do with trust for asset protection. The purpose of a trust really is to avoid probate. What a trust generally does, and we'll get to it in a second. But for our purposes, we'll be looking more at the privacy aspect of the trust and the asset protection of a trust. So a trust has three parties involved. One is the grantor, the person who has assets, and he grants it to the trust. That person creates a trust and he puts all his money in the trust. The trust agreement says exactly the rules, what that money in the trust, what you're going to do with it. And there are 1,000,001 different trusts that can be done for all different things, either for inheritance or for, you can split who gets the property, who gets the income. There are a million ways to slice it depending on what your goals are. Then there's a trustee. The trustee is the person responsible for taking that agreement and fulfilling it. That's the trustee's job. And then there's the beneficiary. The beneficiary is the person who benefits from the trust, who either will get income or get the property at a certain time or get the property for any condition, that any event that may occur. Now, what's interesting about trusts is that it's very easy to play with, but again, you can't do anything with it. You can, for example, have a grantor, a trustee, and beneficiary that are all the same people. And that works for different reasons. But the typical trust, like I said, is for probate. So assuming you have a grandfather who wants to give their grandson, who's the beneficiary, all his money after he dies, and he doesn't want to go through a will because a will is very expensive and it goes to probate court and it takes a lot of time. So what the grantor does is he puts it in a trust, and the trust instructions say, after I die, it goes to the beneficiary. So there's no court because the trust is a legal document and we just follow whatever trust says. So as soon as that grantor dies, automatically the money goes to the beneficiary. So now let's see how trusts fit in for our purposes. There's one fundamental of trust is there's a difference between a revocable trust and an irrevocable trust. If a grantor puts money in a trust, the question is, can the grantor ever revoke it and take it back? Or is it no longer part of his estate and it's totally disconnected from them? Now, obviously, you're thinking what I'm thinking, and it's obvious that we're talking about asset protection over here. Because if it's revocable, then there's absolutely no asset protection, because the court will just say, if somebody comes after you and you say, well, it's in a trust, the court will say, no problem, revoke it, you can. If it's irrevocable, then the court may revoke it and may put it back in the grantor's hands for the creditors to take. But by the nature of the trust, they really can't take it unless the court allows it. And we'll see that you can't just create an irrevocable trust and wipe your hands clean from your creditors. So the classic privacy trust is called a land trust. And this is, it's the weakest of all trusts. You have somebody who is the grantor, he puts the money in the trust, or he puts the property in a trust. He puts legal title in the hands of the beneficiary. The beneficiary can be himself. The beneficiary is not, a trust is not a public record. So he gets a trustee and the property is no longer owned by him. It's now owned by a trust for the benefit of himself. And the trustee has no powers to do anything. He holds all the powers. All the trust has is legal title. Now this is as sham as you can get, because he's just listing somebody else on the property, and that person has absolutely no control over the property. But it works in certain states for privacy protection, and the states allow it, and they don't force you to publish who the owner is. A lot of states don't allow it, but there are ways to create revocable trust that it will hold up in all states. So again, let's run through some of the details of a land trust. The trust holds legal title. The beneficiary controls it. It's revocable. It's meant only for privacy. Now, here's the beauty. This is an easy, very easy way to transfer land, because if I want to transfer land, it's complicated and there's a transfer tax. But if I have it in a land trust, all I have to do is switch the beneficiary. Now, the beneficiary doesn't, switching the beneficiary is not transferring land. It's just switching a beneficiary. So there's no transfer tax. There's no deed. Nothing changes. It stays. The deed is still in the trust, and you can sell it to somebody else. You could transfer it to anybody you want. Again, you're the beneficiary. You call the shots, and you can now move your property to somebody else without doing almost anything. And the downside of it is that this trust has absolutely no asset protection. As soon as somebody sues you, and they win, and the court asks you to disclose all your assets, that's the first thing you'll have to disclose. So one thing you want to do if you have it in a land trust is you want to change the beneficiary to an LLC. So you create an LLC, the beneficiary is now the LLC, and therefore the property is now protected through the LLC. Now we have asset protection trusts. These things were made famous by offshore trusts in the Cayman Islands, the Cook Islands, and other places. What they did was they were very serious trusts where you had to transfer all your assets. There was a trustee who controlled everything. Typically, it wasn't revocable. So this really took the assets out of your hands and it put in the trustee's hands, never to return again. Now, of course, you control the instructions of the trust and you control who the beneficiaries are. So they can be your children or whatever else you want. And it's possible that you could even get some of the income from the trust, but it's really out of your hands, but it's totally protected. And one of the reasons why they were put offshore is because these offshore places made very, very strict rules and very good protection for these trusts. At some point, certain states said, why can't we have protection over here? So there became a new concept called domestic asset protection trusts. And Nevada, South Dakota, Alaska, and Delaware, they allow domestic asset protection trusts where they will give you almost full protection if you follow the rules. And of course, the rules are very strict, but it's possible and you can still benefit from your trust and have total asset protection. So these are irrevocable, they're trustee controlled. The grantor could be a beneficiary and it has creditor protection. Now, in states that if you create an asset protection trust that don't allow it, again, the courts can just say that there is no asset protection. It doesn't make a difference that you created a trust. It doesn't make a difference that you have no power over it. The creditor has a right to, they'll overturn the trust and give the money to the creditor. Liens. Liens are a great way to hide your assets. And here's what we do. You record a lien on the property. And therefore, when a lawyer does a search and they see, wow, you own 5 properties, but then they see that everyone has a lien up to and has very little equity in it because most of the money, most of the equity is tied up in a lien. So this will make it very unattractive for the lawyer to go after you because they would have to fight to remove the lien before they can get the money. And they may not know exactly what's going on with this lien. Let's explain a little bit. You can take a HELOC. Okay, so you can lend money on your HELOC, which means you're not getting any money, but the HELOC will have a lien on the total amount of the HELOC. You don't actually have to draw any money and there will be a lien. You can refinance. You can get a second mortgage, you can refinance and you could take the money and then the bank will have a lien. Now, if you refinance and you do take the money, then you'll have to figure out where to park that money in other places in order that that money is not available to creditors. So you can put it in another LLC and buy property and make liens on that. There are many ways to make that money not creditor friendly. Now, there's something called a friendly lien, which is a little bit dangerous, but it's what you can do is if no bank wants to give you a loan, you can set up your own LLC. And that LLC can have a loan agreement with you and lend you money on and have a lien on the property that on your property. But in that case, if it's a friendly lien and people figure out who the owner of that LLC is and they see it's you, you better make sure you did everything by the book, real appraisals, and we'll get to it in a minute, because if not, the court will very quickly overturn that friendly lien and the lien will be as if you never had it. And then you could cross-collateralize. You can use your property as collateral for other properties to take out other loans, and therefore there'll be a lien on that property as well. So here are the challenges. First of all, something called a fraudulent conveyance. And if the court finds that you had a fraudulent conveyance, not only will they overturn the lien, but they'll also give you a penalty. There's legal compliance. You better make sure that when you do that loan, and everything is done according to the book by lawyers, and that's going to cost you money. It's not, you can't just scribble on a piece of paper and register the lien. You'll have to find a place to park the money if you actually take out a loan, and the costs. It will actually cost you money to set this all up. So last but not least, we discussed all the different tools that we have for asset protection, but this is, you have to be wary, and we mentioned it a minute ago, the fraudulent conveyance laws. A fraudulent conveyance is a transfer of assets with the intent to hinder, delay, or defraud creditors. And it's governed by the Uniform Voidable Transactions Act. And there's also state-specific transfer laws, which anything done that violates any of these laws will obviously be overturned. So there's two types of fraud by fraudulent conveyances. The first one is intentional fraud, where there's a lawsuit against you. And what do? You then turn around and you transfer it to a trust, or you get a lien on it. It's too late then. Even if you know that there's a pending lawsuit or something is going to happen and you know you're in trouble, and then you do a transfer, it will still be overturned. And therefore, you better make sure that this was done a while before anything happens. There's also constructive fraud, which means that you get a lien that's for less than you put a lien that's much higher than any deal you made. You don't have real loan, you don't have real interest rates, or you do something that makes the LLC insolvent or unable to meet the obligations. So you actually conveyed it, even though you didn't transfer the assets, but you made the LLC worthless, and therefore illegally and fraudulently, and therefore will be overturned. So when it comes to fraudulent conveyance, these are the things that you should know. Timing is critical. You should avoid obvious red flags. You should stay solvent after the transfers. If you're totally insolvent after the transfer, then that will be constructive fraud. You need to document every part of every transaction, and you need to provide reasonable value if you exchange something. If you sell your property to your son for $2, then that's not going to work. Everything has to be at arm's length. You have to show that everything is reasonable. So now we covered, I hope that you had a decent overview of what asset protection looks like, a little insight to some of the tools and some of the theory behind asset protection. And if you have any questions, you are welcome to reach out to me. If you enjoyed the webinar, we have other webinars. You can see them on YouTube on our NUCO filings. And if you'd like to reach out to me, you can reach out either by email or by phone. We are, at our core NUCO filings, our experts, assistants with LLC structuring and forming LLCs and the Corporate Transparency Act. We have a portal for easy management of the LLCs and for filing the BOIs, which is connected straight to FinCEN. You never have to go to FinCEN again. And you can easily track and update your BOI reports. And we're registered agents in all 50 states. We operate in all 50 states. Everything we do is across the United States. And we're always happy to help you and to answer any of your questions. Thanks for joining us. I really appreciate it. And have a great day. And stay tuned for what's next.